The Fed decision is in. Welcome to the Lowdown. I'm Mike Smith, and welcome to the Lowdown. Today's joining me is Kevin Lenox. And Kevin, thought we'll just kick off. We've got the Fed decision that was in yesterday. And why don't you kind of enlighten us what was said, what was done, and what was expected?
It was what was expected as far as the statement.
Okay.
So they view the economy and as more balanced at this point, and they don't feel the need to be restrictive any further. And we did not get the fireworks that we normally get in the presser, where the inner dove within Jay Powell comes out, as he did in December, and basically declared victory over inflation.
Yeah.
He did not do that yesterday. He looked actually uncomfortable.
He did.
And I have to stick to the script, which he did. The notable points were that, and it was late in the presser, he took the March rate cut out.
Correct.
So he was asked specifically about that, and they said, we're not having those conversations at this point. So the market went down right after that. The market was baking in at least one rate cut in March, 4 or 5 for the year. And I think all he was doing is he just, after 6 months of data, and he kept saying, we only have 6 months of disinflationary data.
Yeah.
We don't want to move too quickly. It's an arduous process to begin the rate cutting cycle. So we want to make sure we have it right. We still have a very strong economy. Financial conditions are very loose. The employment situation is stable and balanced, I would say, is probably a good way to put it.
Sure.
So he wasn't under pressure to cut rates. And I think really all he did was defer the rate cuts just to see more data. He asked, well, do you need more data? You need better data? And really it was just more data.
Well, it seemed like the Fed is, more in like a risk management mode, so to speak, and again, looking for further data. And this is one thing we have to warn people and being careful of is, if you look at the beginning of the year, this market was priced for perfection, right? I think at some point I saw it was priced for 8 rate cuts. And what we heard yesterday, I think, is very relevant with the re-onshoring, everything that's happening in the world. Inflation doesn't normally just come in one wave; it comes in several waves. So I think he's smart in saying, let's wait for the data. Let's not get it too ahead of our skis. I think that was probably the first time I've seen Powell in a long time really kind of hold to his gun. So I'll say that's a different Powell than I've seen. But I think he stuck to kind of his guns there for once.
Yeah, and he didn't want to pivot again. He was showing that last year.
He's tired of pivot, Powell.
He pivoted and went up with egg on his face.
Yeah. No.
But what's unusual, every cycle is different. So there's no rules-based process to how you trade this. But I haven't seen before in my career is that financial conditions are looser now than they were before the rate hike cycle began in March of 2022. That's not the intent. We've gone from 0 to 25 basis points to 5.25 to 5.5, and financial conditions are looser.
So what's that telling us?
High yield spreads are lower as well. So you don't have the type of conditions that you typically do at the end of a rate hiking cycle. And normally rate cuts are aggressive. They happen quickly, successively. And this isn't setting up that way because we don't have a sharp downturn that's evident in the economy yet. And part of this is back to, why aren't we in recession?
Exactly.
Janet Yellen was asked,
okay.
For those of us who thought we were going to be in a recession, by this point, what do you have to say to that? She goes, I told you so.
So basically we bought our way out?
What Wall Street wasn't counting on, I certainly wasn't counting on, was 7.5% of GDP deficit spending.
Yeah.
It's a tidal wave, a tsunami of spending that has really kept the economy afloat. And being an election year, it's not going to stop.
Well, so that kind of gets us into what have you seen in the earnings picture? Now, one of the things I've noticed amongst look at some of the food companies, Chili's, look at Starbucks. They're actually they're growing their revenues. They're taking that extra revenue and using that for brand advertisements. They're seeing a huge demographic shift. And just to kind of give you an idea, boomers preferred hot coffee. Now the millennials and Gen Xers preferred cold. But they're making lots of spending and advertising. But what else are you seeing on the earnings front? It doesn't look recessionary, by the way.
No, it doesn't. So earnings were, I think for last year, earnings are going to wind up for the S&P 500 being up 1 to 2%.
Okay.
So the gains we had last year was all multiple expansion.
Exactly.
So what we're looking at, the consensus earnings gain for this year is 10%. The people I follow more closely are around 4 to 6%. I think that's probably a better number, but all eyes right now are on the big tech companies.
Yeah.
So we had Microsoft come out. They beat on the top line, beat on the bottom line. They're trading at 35 times forward earnings, the highest since 2000.
Just
and those Magnificent Seven stocks, I think, are 28, 29% of the S&P 500.
They just seem unstoppable for here.
and tonight we have Apple, we have Amazon, and Meta. So there'll be fireworks after that. But so far, the banks start the earnings season, and it was, They did increase their loan loss provisions, but nothing really blockbuster. And now it's big tech's turn, and so far they've for the most part met expectations, but certainly haven't beaten them. So we've got this stagnation here. We'll see what happens tonight, but I'm hearing through back channels that Apple's iPhone sales may actually decline this year by 10, 12-ish% based on structural reasons, but we'll see on that.
I think we're moving to glasses now for what I hear. So we'll see.
There's a lot of pressure on the big tech stocks to keep this market up. That's where the strength has been. But on top of that, we talked about the Fed cycle and all, but it's important to watch expectations for earnings growth.
Yeah,
I think one of the best places to look at that is how are cyclical stocks doing relative to defensive stocks.
Okay.
Stanley Druckenmiller, I think I mentioned it last time, he said the best economist that he knows is inside the stock market.
Agreed.
So are money managers expressing a positive view by buying economically sensitive cyclicals, or do they sense a recession and therefore buying the more defensive consumer staple type names you mentioned before? And this latest rally since the beginning of November has been led by cyclicals.
Yeah.
Tech obviously is right up there, but that's a positive sign to see, and that means more than changes in the yield curve. So whether you look at yield curve flattening, steepening, and all, there's too much focus on that.
Well, you're talking about the inversion of the yield curve, which has been a precursor to a recession.
And then the normalization, where that means basically you're in it.
Exactly.
Or you've been very, very close, and we're starting to normalize now, but we're not getting the signal from growth to confirm that. So I would take the signal from inside the stock market and the buoyancy within the credit markets as the better signals to follow.
Well, look, Kevin, as always, good information, and looking forward to having you here pretty soon, the next month, and we'll see what the data tells us.
Sounds good.
Thanks, Kevin.